Welcome back to another video on FinanceValue TV. Now in today's video, we're going to be discussing the potential for the stock market crash and particularly someone's opinion, which is Ray Dalio's. Now I do want to say that the stock market crash isn't a relatively new topic. This has been something that's been on the tip of every investor and everyone who's interested in the market's tongue for quite some time now. In this video, he does mention stock market bubble, and he didn't exactly say too much about it, but what he did say was enough to show us that we probably are in a bubble. Now, he pretty much said that this bubble is pretty much halfway as it was in somewhat a similar sense to 1929 and the 2000 dot-com bubble. So what we're going to do is we're going to take a look at the small clip from the interview where he does talk about this bubble. Once we show this clip, we'll then discuss at length what he says, and then we'll dissect what it means for the economy moving forward. So if you just watch the video clip, you could see exactly what billionaire investor Ray Dalio has said. And taking things into consideration, this article kind of describes in a nutshell exactly what he basically said, and it breaks it down, and we're going to be talking exactly about this. So let's take a look at this Yahoo Finance article, which just clearly discusses what was said. So he cautioned that some high-performing stocks have benefited from a single-minded speculative trading focused on price. And he attributed recent market volatility to a rotation towards meat and potatoes companies that didn't benefit from pandemic trades as much as some tech firms. What's happened is that, like a lot of cycles will go, a lot of new ideas, new technologies and things come along, and fabulous revolutions, he says, and they grow, but there's a tendency of investors to extrapolate the past and not pay too much attention to price, and when that happens, you start to emerge as somewhat of a bubble. So of course he clearly says that this can happen as a bubble. Now, looking at what he says here, he does say that the high performing stocks benefited from the focused minded trading on price, and the market volatility actually rotated out of many different companies. Now, the market volatility mainly rotated out of companies we know, such as the airline companies, the tourism industry, and the travel industry. Many companies such as Boeing, all of these companies decided, well, they didn't decide, they actually unfortunately lost large majority of their stock prices due to the travel industry being hit by COVID-19. And of course, as you can see, what he says here is that companies didn't benefit from the pandemic trades as much as some tech firms from the likes of Facebook, Amazon, and Microsoft. See, these are the firms that benefited because these are tech companies that are all online, and they received massive amounts of uses such as Zoom. You know, when everyone's at home on Zoom, these old meat and potatoes companies are left in the dust. But this is only a temporary leave. So of course that's what he's saying. So all of these new technologies and stuff is happening and benefited from this huge increase. Now, of course, right here, as you guys can see, the bubble is not what it was in 2000 and not what it is in 1929, but it is halfway there. Now, halfway there means that we probably do have a little bit of way to go. Now, one thing you need to understand is that nobody, and I mean nobody, can accurately predict a market bubble. No matter who you are, no matter how great you are at, economy, no one can predict an entire market bubble. Now, of course, sometimes people do accurately do this, but it isn't something that can be predicted with striking accuracy. It's usually something that's given up to chance. Now, of course, as you guys can see here, so as you can see as the article goes on, the warning from Dalio echoes growing concerns among some investors. But a recent note from Goldman Sachs tamped down such anxieties, arguing that the risk of an imminent bubble is relatively low. So some people are saying, that stock market bubble isn't there. So as you can see what he's referencing, well, what the Yahoo Finance is referencing, they're saying that investors may be growing anxious about stock market bubble, but Goldman Sachs is actually stating the opposite. Now, of course, it's always interesting to see points of opinion that are contradictory to the point that you hold, because this allows you to open up your mind to see the potential that you could be wrong and the potential that there are other possibilities for the markets. So Goldman Sachs said, while there are pockets of excessive valuations in equities, as we know, with potentially some companies like Zoom skyrocketing in value, potentially not with the intrinsic value, maybe just with a pandemic fueled value, the markets are justifiably derating as interest rates adjust. In our assessment, only a few of the common characteristics are currently present or being partially met. So they're saying that only the current common characteristics are being partially met for there to be a market bubble. bubble. And that was a global chief equity strategist that actually said. It goes on to say that importantly, the absence of significant leverage outside the government sector and the early stage of the cycle suggests that the risks of an imminent bubble with systemic risks to the financial system and economies is relatively low. So this is what they're saying. They're saying that, so despite Ray Dalio saying that there's fears of the bubble being right like it was in 1929 and in the 2000s, they're saying that maybe it isn't that bad. It also says historically low interest rates have made stocks more attractive to relative to other points in the past, which is really true. And secondly, the biggest companies in the market deserve their valuations and they actually produce strong cash flows due to their dominant market positions. As we all know, Apple has literally $260 billion in cash. And then the research found that there isn't widespread ownership risk of assets despite the run-up in markets of the 2020 COVID-19 lows. So we do see somewhat of a balance, but you have to know that this is, once again, all speculation. Nobody knows exactly what's going to happen until more time passes. Now, when it comes to the market crashing, you do have to take into account other opinions like we just stated. Now, of course, if you've been paying attention to the markets, you'll know that there are a few speculators and other people that are also giving their opinions on where the market crash will go. One of the most notable investors of our recent times is Jeremy Grantham. This is a British investor who manages over $118 billion of assets as of March 2015. Now, he recently did an interview where he recently stated some worrying concerns because he said that this recent crash is going to rival the 1929 crash and the 2000 dot-com crash. He does think this is a bubble and it will burst. And to be honest, if you watch the interview, the points he raises does actually kind of scare me because the things that he's saying is actually quite true. You know, there's proof in the pudding of what he says. Now, here's a quote from his interview. He said, "We will have a few weeks of extra money and a few weeks of putting your last desperate chips into the game, and then an even more spectacular bust. When we've reached this level of obvious super enthusiasm, the bubble has always, without exception, broken in the next few months and not a few years." So how bad will the next crash be? Very bad. That's what he indicated. So I don't know when the crash is going to happen, but we do know that it is going to be a potential for the market. Now, there are some other indicators which are independent of what other people think. One indicator that many people can use to predict whether or not the market is valued or overvalued is going to be the Buffett indicator. Now, the Buffett indicator is currently not in many people's favor. So the Buffett indicator, as we can see on this website, currentmarketvaluation.com, clearly indicates that the Buffett indicator is suggesting that the market cap is strongly overvalued. Now you can see exactly how the Buffett indicator works out this calculation. It says that by their calculation, currently 79%, or about 2.58 standard deviations above the historical average, suggesting that the market is strongly overvalued. These are historical all-time highs. However, with interest rates at historic lows, that there is reason to suspect that this time is different may hold true. So what they're trying to say is that this is actually quite different this time. So as you can see, the historical chart of the Buffett indicator is shown below, and it basically points to the two biggest crashes. Well, the two biggest crashes since the one we're about to enter. But as you guys can see here, it says internet bubble 67%, bottom of the financial crisis minus 48%, and as of March 25th, 2021, the 223% of the market value to GDP, 79% higher than the long-term trend line, which is plus 2 standard deviations than what we normally see. So, as you can see, this is probably the best indicator right now. Now, of course, with every single valuation model that looks at the stock market and the S&P 500 tracker index, there are going to be some shortcomings. But at the end of the day, we only have a few of these tools that we can look at to accurately see. Now, looking back on it, we can clearly see that the Buffett indicator has accurately predicted the highs and lows of the previous crashes, leading us to think that Ray Dalio is probably correct when he says that this could probably go further because interest rates are low and the Federal Reserve is actually printing out millions and trillions of dollars, which Americans are probably gonna keep on using. So to be honest, right now it's anyone's guess, but if history is doomed to repeat itself, things aren't looking good.